Welcome and thank you for joining us this morning. As you're aware, this isn't a meeting, it's a webinar, which means that it's a bit like watching your TV at home where you can see us and you can hear us, and no different to the panelists can't see you, or we can't hear you. If you need CPD, be sure and email either myself or Owen after it, and we can email you out the cert. For the questions and answers, you can do this through your Zoom functionality, or you can email either myself or Owen. Ian will take his questions after his presentation, while Brendan and Owen will take their questions at the end of the session, which will be after Brendan's presentation. So I'm delighted to introduce Ian Slattery, who is head of investment solutions at Zurich, who have 30 billion euro of assets under management over in Dublin. Over to you, Ian.
Thank you, Sean. I'll just share my screen, and although it mightn't be obvious, I am the person in the invite. I don't know where they got the little bit of an older picture of me, but very kind all the same. What I would like to do just for the next 15, 16 minutes is just bring us all through a little bit about what we've seen in investment markets this year, the economic cycle, where we stand at the moment, a little bit of the view from Zurich. So we do have a view as an active investment manager. We have a good track record, but there's varying views out in the marketplace, and just finish off with a couple of long-term investment principles, which I think is important, just in relation to providing perspective and what we need to remember as long-term investors. So there's no better place to start, I believe, with these presentations than inflation. It is the big talking point in the economic circles over the last number of years. There's various ways to slice and dice inflation, but I'm just bringing up US, Eurozone, and indeed just to give the Irish context as well, represented by the three lines. And the big takeaway for us at Zurich is we see the peak a little bit different, but in general, the peak in the summer of 2022 for all three lines, and then very much a clear downward trend since, coming through into August and September of this year. For the eagle-eyed view, you'll notice on the right-hand side that the dark blue line, the Eurozone figure, extends a little bit further than the other two lines, because yesterday morning we had the latest inflation print from the Eurozone, and it came in at 1.8%. So you often hear about this idea of 2.5% as the ideal target for inflation. We're very much there at that level within the Eurozone. And I know people on the ground may not feel that. Always remember, this is annualized inflation. There's still the cumulative effects that we've seen. But from an economic perspective, inflation, it looks like, is getting under control, as characterized by the lines shown on screen. Just to take another important point for central bankers, most central, if not all central bankers, has inflation as an explicit mandate. But if we also look at the Federal Reserve, the key monetary policy makers globally from the US, unemployment is very important for them. And it's fair to say unemployment is a big input into thinking within the Eurozone as well. I've said trending positively here, and it's more of a flat line, right? It's not necessarily trending downwards, but the big thing for us at the moment is it's not spiked upwards. If you remember 2022 being a poor year for investment markets, that was very much around the fears of what we might see from higher interest rates, and one of those lagged effects was forecast to be higher inflation. But inflation has remained, excuse me, higher unemployment, pardon me. But unemployment has remained under control. We think of 4 to 5% being a relative neutral rate for unemployment. The US and indeed the Irish context very strong there. A little bit of a different picture in the Eurozone, but fair to say, whilst not stellar, unemployment is not rising as of yet. If you put those two things together, and we pull together what interest rates look like at the moment, and it's fair to say the cycle has turned. It's remarkable to think just over 2 years ago, in the summer of 2022, we were still in a negative interest rate environment in Ireland, and we saw that and in the Eurozone, we see that lockstep up from both the ECB and the Federal Reserve, up to highest rates about this time last year, plateaued for about 12 months, and then we saw 25 basis points, or 0.25% cut from the ECB in June, another one in September, and we saw the first cut in 4 years from the Federal Reserve, 0.5 or 0.5% at their September meeting. In terms of the direction or the pace of interest rate cuts, it's no surprise, or there's a consensus here that we will see further cuts from both the ECB and the Federal Reserve throughout 2024 and perhaps into 2025. But it's fair to say we do not expect to see them coming down to the close to 0% we saw 3 years ago. So they will come down, but they will plateau or settle at a higher level this time round than they did in the past. As active investment managers, the way we look at the world is inflation and unemployment feed into interest rates, which feeds into GDP growth. That's the thought process and theory from our perspective. I've dropped the Irish line from this one because Irish GDP figures make the charts look a bit strange, if that's a technical term I could use. Similar to my sentiment or my thoughts on unemployment, GDP growth, it's falling, but it still remains positive. And similarly to what I said about unemployment, one of the big fears was we would see a recession on the back of higher interest rates. That has not uh, emerged so far, and we still see very strong growth from the US. Not so stellar from the Eurozone, but I suppose when we look at the left-hand side of the chart, that's the kind of the post-COVID pent-up demand in economic activity. So similar enough to my comments on unemployment, it's not stellar. It's not at 3, 4, 5%, but it's not in recessionary territory either. And there, as the Americans would characterize it, it looks like we've hit this Goldilocks scenario. The economy is not too hot, nor indeed is it too cold, and we haven't got this recessionary fears just yet. And we may have this idea of a soft landing in terms of interest rate policy, or indeed no landing at all. And that's part of the reasons why we've seen strong equity markets so far this year. Just pulling those charts together, just to give you kind of key takeaways: inflation and unemployment trending in the right direction, interest rates are coming lower, and GDP remains positive. So overall, an okay picture for the global economy. In terms of my own particular focus, what I'm interested in is how do those economic factors impact investment markets. So I'll just pull up in terms of the year so far for three key lines that we look at is the world stock market in the dark blue, the US in the lighter blue, and Europe in the beige. I could have given and I have lectures or discussions or webinars on this each of the last 10 or 15 years, and you would have seen that light blue line ahead of the dark blue line. American exceptionalism in terms of stock market performance has dragged the global stock market higher. You'll notice about 3/4 of the way through, we see the V-shape movement that we saw at the start of August. If you'd taken a few extra days off at the August bank holiday, you would have completely missed a 10-12% fall in Asian markets as the subsequent recovery was so strong. You'll notice the beige line on the very right-hand side, European stocks have outperformed. If you just look at the movement of the line in the last couple of weeks or so, and much that is to do with the performance of luxury stocks as a response to increased policymaker action in China. For example, the Chinese stock market saw its best day since 2008, up 8.5% on Monday. So policymaker action in the Far East is aiding Eurozone stocks, which have a larger proportionate exposure to the Chinese middle class. Looking under the surface of the global stock market, we've looked at it a little bit there in terms of geographies, looking at different sectors. If underneath the surface of the MSCI World, the one that we have the blue outline in the middle there are 11 different sectors of the stock market. It's interesting to see that we have spoken very much in the past about large sector dispersion. And I've seen a 60, 70 point spread of plus 65 to minus 25 in terms of the best performing stock market sector versus the worst performing. Interestingly enough, this year, and this isn't actually as common as you may think, we see all 11 sectors of the stock market in positive territory, ranging from energy at about plus 4.5%, 5%, all the way up to the consistent darlings of the market, technology and communication services. In terms of some other sectors that are doing quite well, you'll see utilities and financials in third and fourth place. And they are companies, or they represent companies that tend to do a little bit better when we see falling interest rates. So it's not just that the stock market as a whole takes falling interest rates as a positive piece. Different parts of the stock market also react differently. And that's something we try and take advantage of as active investment managers. I suppose changing tack a little bit now to looking at bond markets. And I have here two key things that we look at is the US 10-year bond in the beige and the German 10-year Bund or bond in the blue. You'll notice the numbers on each side are different. I've just scaled them to show the correlation. So the numbers that start at 4 in the middle on the left-hand side represents the US level, and the one that finishes at about 1.8 on the right-hand side is the German level. But the idea is as a bond yield goes up, bond prices go down. So for the first half of the year to date, bond yields, as shown on the chart, are going up and bond prices are going down. So you're losing money in bonds. However, as you see these lines move downwards in the second half of the year so far, that's been positive for bond prices. So we have both equities and bonds positive year to date. Another important part of our investment universe is commodities or alternatives. And I'm just showing you each of these bars represents the monthly performance for either gold, oil, or copper. I've tried to make gold a fairly gold color. Maybe it's beige, depending on your screen resolution, but you can see it's consistently been strong. In each month so far this year, that gold bar has been positive. Interestingly enough, if I look at copper in the blue, it's had a bit more of a mixed picture. And again, if we think of what copper is, it represents industrial and economic activity. So it's something that we're looking at quite closely is kind of bellwether inputs into manufacturing globally, and copper would be one of them. It's had a strong September, which is good news after a couple of quiet months in terms of price action. Interesting enough, if I look at oil, I actually spoke at an event yesterday afternoon, and I used this particular slide, and I said it's interesting to see that oil has fallen in the last 3 or 4 months, and it hasn't responded or reacted to any of the geopolitical concerns in the Middle East, which was probably a good time for it to spike 5 or 6% last night, up to above $75 per barrel. In terms of the increased conflict with Israel crossing the border into Lebanon and the response from Iran. However, overall, we do believe that oil, whilst it can move in the short term for geopolitical reasons, it will continue to be led by ongoing demand in terms of economic activity. To pull this down, if we looked at the economic backdrop, we've looked at investment markets overall, and I just want to look at what that might mean for investment funds. So this chart is pretty busy, but I'm using the Zurich Life Balanced Fund, which has a track record going back from 1989. So the first calendar year performance for that fund would have been in 1990, right through to 2024. So each of these grey lines on screen show the line performance of that particular fund in any given year since 1990. So you can see some very good years at the top. 2008 is that outlier right at the very bottom. And I'll just overlay it with the return for the balance fund so far this year, just to give you some context of how has 2024 been for a multi-asset fund versus history. And you can see it's pretty strong. As I've mentioned, we see alternatives represented by commodities in positive territory, cash in positive territory, bonds in positive territory, and equities, the main driver of long-term returns, having a very strong year as well. So overall, a good year for multi-asset funds and a good year for a fund such as ours in terms of the balanced fund. I mentioned a number of times that we are an active investment manager, and we manage 38 billion euro locally here in Ireland for people like yourselves and other customers in the Irish market. And we do have an outlook in terms of being an active investment manager. So if I was to characterize our outlook currently, it would be quite balanced. So an active investment manager isn't always about, or active investment management isn't always about making big decisions. So we are very much neutral between equities and bonds. So we acknowledge that equities have had a very, very strong run of it, but bonds do represent opportunities in terms of being in a positive yield environment for the first time in almost a decade. We do maintain an overweight allocation to alternatives. And what that really means is we do have a preference for gold and copper at the moment, and that's been a help for returns in particular funds as well. And we're overall, we're fairly constructive into the medium term. And we do believe the economy is at an inflection point. First rate cuts of the current cycle. As I mentioned, the Fed hadn't cut since to the year 2020, and that was very much in response to COVID. So this idea of raising rates, plateauing, and then reducing. It doesn't happen as often. But I've mentioned, or I've at least alluded to a couple of times, key metrics such as unemployment and GDP and their associated leading indicators are something we're keeping a close watch on. Always cognizant of risks. We're just over a month out from the US election. That in ourselves, we will be avoiding binary decisions on it. So we don't have a preference from an economic perspective on the Harris v. Trump. The one point we would say is we do think it's dangerous to extrapolate the economic policies of Donald Trump's first term and assuming that it would be the same in the second term. So that's one point we'd make. Also, the lagged effects of monetary policy. Just because interest rates are now falling, it doesn't mean that higher interest rates don't impact people. As somebody on a fixed rate mortgage, and I'm sure many other on the call, you'll empathize with that particular sentiment. And that's something that affects both companies and individuals. Also, sustainability of fiscal deficits. I know there'll be some talk on the budget later on, but Ireland is quite unique in the fact that it is running a primary surplus, or we did, I suppose, until we spent most of it yesterday. But the idea of countries being in structural deficits in terms of their government debt is something we keep an eye on. And geopolitics, we haven't seen massive contagion into equity markets for some of the things we've seen in the Middle East and in Ukraine or in Taiwan, just to name check a few. But that doesn't mean that we won't again in the future. So always cognizant of the risks that we might have. But at the moment, constructive medium term, but balanced in our asset allocation. I just want to turn for just 3 slides and another 2 minutes, just in terms of some investment principles of how we look at the world. And I think this is the idea of providing perspective and standing back a little bit. And I realize that or acknowledge that this chart is quite busy, but I'm showing you is just a return for Eurozone equities. And the blue bars represent the calendar year returns going back to 1980. So as you can see, the majority of them are positive. The red dot shows the peak to trough within that particular year, if you were the worst possible investor in any given year. And what you'll notice is in almost every case, the blue bar is higher than the red dot. And what I'm trying to show to you there is there are always times when within a year markets are down, and it feels like our behavioral biases almost feel as we should be compelled to do something about it. But you look over the long term, the red dots are always lower than the blue bars, and very much sticking with the plan is very, very helpful. To make a similar point in a slightly different way, and again, I like throwing in the odd complicated chart. What I'm showing you here is in the dark blue equity returns over any 1 year. So any 1 year, the last 50, you could have got plus 61 for equities or minus 43. So a really large range. We see in the beige bonds and then the lighter blue, the 50-50 portfolio. And I won't go through every bar, but as we move from left to right, 2 things happen. Firstly, the bars narrow, and secondly, they skew upwards. So the longer we remain invested, most likely through a pension, we can be sure of 2 things. We have more certainty in our returns, and those returns are more likely to be positive. So just reiterating perhaps a similar point to the last slide. And one of my favorite charts, I always try and throw it in whenever I can, the near 100-year track record of the US stock market. It's the stock market we have the most data for on, with the bull markets, the nice bits shown in blue, and the bear markets in red. Just visually looking at it, you can see bear markets. You can expect, or history tells us that we'll see a bear market at least once every decade. However, they tend to be short, they tend to be sharp, and they tend to recover quicker. Whilst the blue bull markets tend to be longer, they tend to be steadier, and they tend to reach higher highs than the lows of a bear market. So similar enough to what I've said already, a series of ups and downs, but you should expect to see these big moves downwards at least once a decade for investment markets. So just that's the end of the comments for myself. Thank you very much for time. Just in terms of closing remarks, strong positive outlook for the stock market as it stands, however cognizant of risks, but in those last couple of points, just keep a laser-like focus on the long-term journey. Sean.
Thank you, Eoin. We haven't got any questions in you, so thanks for your very...
Can I ask a quick question before you go, Sean, if you don't mind?
Of course, yeah.
Eoin, I'm always conscious of the fact that because we're Western-centric in our media, if you split the world into Euro, US, and Asia, we're always aware of the problems in Europe. We're always aware of the problems in US. Is that because Asia is calmer, or just because we don't get the same exposure to the media?
I wouldn't say calmer. I'd say it's a media exposure piece. I suppose if I could look through an economic lens, if I divide the stock market into percentages, 72-73% of the global stock market is in the US, another 15% is in the Eurozone and the UK, about 8% in Japan. So the rest of the world, take India, South America, parts of Asia, the whole of Africa, is less than 10% of the global stock market. So that's probably the lens I put it through, and that might seem a bit cold from a societal or a humane impact, but purely from an economic perspective, that's what we'd see. It's the same old adage still remains: if America coughs, the world catches a cold. That'll change to China at some point, but those estimates have been pushed back a little bit over the last number of years. But we try not to have I think that the point in the media is very well made as well. I suppose the wisdom of crowds is in their independence, and the more there's groupthink and things like that, the more dangerous it can be.
Could I actually ask a question as well, Eoin? If I could just on price earnings ratios, if we look, say, at the S&P 500, 1 year forward earnings, price earnings about 22 or so, seems a lot cheaper in Europe, and even the UK. If you look at the FTSE 100, now I know the sectors are absolutely different, but the like the 1 year, taking a 1 year forward price earnings, you're at about 12, right? And some of these are global companies. Is there any case for more value on stock exchanges other than the US?
Yeah, it's a fair point, and we think even within a sector or a geography we're underweight, there's individual names we can like, if that makes sense. There's this concept of a value trap. As I said earlier, you could have woken up on the 1st of January every year and said valuations point you towards Europe, and it wouldn't have worked out. The US tends to tolerate, if that's a word I could use, higher valuations. And we'll actually see, if you look at the likes of Flutter, the previous Paddy Power, but more recently Smurfit Kappa and CRH, people do start to list in the US because they feel they get rewarded more there for it. But there are good names, there's good sectors all across the globe. For example, we would have been underweight many of the so-called Magnificent Seven for much of the last year as well. So yeah, there is always value to be made or to be found, but sometimes the valuation's low because the company's not going to do well, and sometimes it's high because it will. And I know that sounds a very obvious thing to say.
Sure.
Yeah.
Thank you, Eoin, for that great presentation. Right, so we're going to move on now, and I'm going to introduce my colleague, Eoin Buckley, who will speak about recent pension changes.
Great. Okay. Thank you, Sean. Right, and good morning to all. So hopefully some slides are appearing there. So what follows here is a 5-minute or so budget update focusing on pensions only. Right. So for me, pensions remain an effective and tax-efficient means of achieving financial freedom. And by financial freedom, I mean the ability to generate a large enough fund so that one day you can stop working and not have to worry about money in your retirement years. So the first slide is a reminder of some of the key reasons why funding your pension remains an excellent idea, right? So some of these haven't changed in the budget, and I'm delighted to say that, right? So when we look at the tax relief and contributions, 40% income tax relief on personal employee type contributions. Now, I just want to express that in terms of, we're used to hearing 40% relief, but I just want to talk about it as a top up, because auto enrollment is presented as a top up. So if somebody makes a contribution of €100, that €40 tax relief they receive, and the €60 that they actually fund out of their net pay, so that 40 over 60 is actually a 67% top up. And why that's important to present is that auto enrollment is out there and it's offering a 33% top up, right? So one message would be that high rate taxpayers should avoid auto enrollment, and the start date for auto enrollment is round about 12 months from now. Employer contributions are even more generous in our current regime. Effectively what you're getting there is 52% tax relief, so it's costing you €48 to have €100 in your pension fund. So that 52 over 48 is 108% top up. Also, it doesn't get enough of a mention. Tax-free investment growth on your entire pension fund is a fantastic benefit for pensions. And the PRSA as a product has been improved dramatically in recent years. It provides a lot of flexibility, and that's still there. And I'll mention that briefly again in another slide. So one thing that did change yesterday was the standard rate tax band increased to 44,000, right? So why that's important is in the context of making your retirement years more tax efficient. So I'm just taking an example. If you look at the middle box, 800,000 of a maturity fund. So we can think of a 65-year-old kind of stereotypical example here. That's the value of their pension fund when they're retiring at age 65. Now, how they got there are those three boxes at the top: the immediate tax relief and the contributions, which are those kind of top-up numbers I mentioned on the previous slide. Of course, the net contribution cost to them after tax relief. And a third plank is the investment growth they get from the markets, which generously the government does not tax. So they're the three items that would help get them to their maturity value. So what I just want to mention there is, well, what happens that when they retire? Well, they're going to get a lump sum of 200,000. So that's assuming 25% of the fund of 800,000. And the balance, the 600,000 into the ARF, that's the bit I just want to grab attention on in relation to the standard rate band. 4% of the ARF, which they will be forced to draw down in their 60s, is 24,000. That's well within their 44,000 standard rate band. So even when you add the state pension of 15,000 or so, you're at 39,000. They still have 5,000 to spare before they hit the high rate of income tax. So maybe they're lucky enough to have some dividend income or rental income. But if they don't, they could dip into their ARF for another 5,000 to hit that 44,000 number and be paying income tax at 20% only. So look, shooting for the stars on the next slide. If somebody has 2 million of a pension fund, so again, those three inputs at the top of the slide are the same. So let's have a look at what happens there at retirement. 25% of the fund is 500,000. A very tax efficient lump sum. The first 200,000 is tax free. The next 300,000 will be taxed at 20% only. So they will receive, within a week or two of retirement, 440,000 into their personal current account. So again, just to focus on the 1.5 million or so, now I'm assuming an ARF, there are other options. It could be a vested PRSA, it could be an annuity, but let's just assume it's an ARF. 4% of that, which they will be forced to draw down in their 60s, will be 60,000. Now, they will pay some money here at the high rate. So the first 44,000 is at the low rate of tax, and the 16,000 above that is at the high rate of tax. So if they said, I don't like paying tax at the high rate, I don't need that money over and above the standard rate band, is there anything that can be done? So there are a couple of points in that. So one is just to make sure that that standard rate band is used efficiently. So I've mentioned 44,000 for a single person. Let's say for a couple, that's 44,000 each. So you could have 88,000 euro coming into the house, all at the low rate of tax. Married and civil partners, so couples there, they can slice and dice that 88,000 number a little bit differently. So if there's a higher earning spouse, they can get 53,000 at the low rate, and the lower earning spouse could get 35. So in our example there, where we had 60,000, now it could be possible for them to get 53,000 at the low rate and only pay 7,000 at the high rate. I mentioned that the state pension that did receive an increase, and starting in January, that's going to be at a 15,000 number. Just to mention, if somebody still in that example still didn't like paying high rate tax, is there anything that could be done? Well, this is where we do get a lot of flexibility with the PRSA. So you could use multiple PRSA policies. So instead of one retirement claim and one go for a 2 million fund, you could, as a pre-retirement transaction, set up 5 PRSA policies of 400,000 each, say, and you could have 5 retirement claim events timed in years that suit you. So for instance, at age 60, you could retire the first PRSA of 400,000, take 100,000 lump sum, 300,000 to ARF, and a year or two later, whenever you choose, you could take the second PRSA, and again in a few years, the third PRSA. and you can keep that going up until age 75, at which point you will be forced to retire all PRSA policies. But it is a very effective way for cash flow planning in retirement to make it as tax efficient as possible. And then lastly, just to mention the standard fund threshold, though this information was a week or two before the budget, but occasionally, not often, but occasionally, I do get a call from someone and they say, oh, I have a pension problem. I've gone over the €2 million fund limit, right? So look, immediately I say you don't have a problem, you have a challenge, okay? But that challenge has got a lot easier because the 2 million fund limit over the course of a number of years will now reach 2.8 million in 2029. So that is good news for anyone with that challenge, right? And just to finish on the point, just to, you know, we had budget announcements yesterday. There will be important and detailed wording to follow in a finance bill, might be as soon as next week, and then we'll have to wait for the Finance Act and see the wording there. So look, I'll take any questions at the end, and for now I'll hand you back to Sean. So thank you.
Thank you, Eoin, and that was informative. So what we'll do is our tax consultant is Brendan Dewey, tax partner at MK Brussels in Waterford. So Brendan, I look forward to hearing what you have to say about yesterday's budget for the next 25 minutes or so.
That's no problem. It's going to be hard to follow the two lads. All right, but she don't need them anyway because we'll circulate them, and if anyone wants a copy of our actual budget leaflet, you can email me. I'll fire on to you, okay? So there's a lot to go through, but most of it, as I said, is in the slides or in the leaflet, and there's no point in just repeating ad infinitum what you already know. So what I want to do, if it's okay with you, is I want to fly through it and then just pause at the small things that you might have missed or the things I think merit consideration, depending on where you are in the world in terms of employer, employee, self-employed, unemployed, wherever the case may be, all right? And I judge every budget by what we were hoping, expecting, told in advance, because otherwise, what are you judging a budget against? You can't judge against what you want to happen, because then we'd have 4 million different views in it, right? So you have to judge by what you hope will happen, because this is what's supposed to, or what they told you, or what's in the program for government, or just what's right anyway. The first thing to mention before we talk about any of the pre-budget stuff in terms of expectation is pre-budget stuff in terms of implementation. Stuff has already happened. PRSI is going to go up every October, 24, 25, 26, 27, 28. You're going to go from 4% to 6%. That's already happened. So while you all got good news in the budget, you're all paying an extra PRSI from this month onward, right? And if you're an employer, it's going up as well. The rental loan interest for residential landlords has already come in. It started 24. Just as an aside for that, one of those things I want to flag to you, there's conditions there around LPT and RTB, but there's also a condition around tax clearance cert. So if you are a residential landlord hoping to take advantage of the RPRIR, you need to have an ETCC before the end of the year. So just put a little note in your phone. There's no point in doing it now because it could be revoked by then. Christmas week, to make sure you've applied for a tax clearance cert, right? Auto enrollment is going to happen, and we might talk to Eoin about that later on, because I've always had a problem with the concept of auto enrollment. To me, you should never need to stick if the cart is big enough, right? But we'll come back to that. It is going to happen. It's another problem for employers and employees. It's another layer of paperwork, and it has. Eoin made a great point earlier on, but PRSAs have become a great thing in the last couple of years, but they were horrible for 20 years before that, right? So, and last but not least, the SFT is going to go up, standard fund threshold. All these things are happening irregardless, to quote a famous US president, right? So we went into this, what were we hoping for, what we're expecting? Well, we were hoping for changes to indexation. We were hoping for change to annual exemption, CAT, exemption limits relief, tax bans, and in my personal thing, tax discrimination against self-starters, self-employed entrepreneurs and professions, right? What we were expecting, because of the feedback we were getting, was an overhaul of the CAT relief and regime, not just relief, the regime itself. finally correcting the entrepreneur relief for small businesses, and a scheme to help small family businesses to deal with the red tape and the hindrances of getting active reliefs and schemes that are already there. That's what we were told. So what actually happened? Well, the tax band did go up by 2,000, as always it's 42 to 44, all the variations for single parents and married couples. There was talks, by the way, of third rate. That's still on the agenda, but don't forget we do have a multi-rate system because USC feeds into this as well. So we don't have 20 and 40. We've got 5, 4.5, 3, whatever, all the way up as far as 55%. Okay. There was a number of tax credits increased. The core ones being the personal POE, earned income credit, single parent. Also a few of the ancillary ones, incapacitated child, blind parent, persons, and dependent relative. Just two things to flag for you in case people don't know this. For the blind person's tax credit, a married couple must both be blind to get the double. It's per person. It's not like the other things which double when you're married. Blind persons requires both spouses to be impaired. And dependent relative includes a widowed parent. So if you're old enough to remember the 70s and all the mother-in-law jokes, right? And you go, what's the point of the mother-in-law living with you? Well, you get 305 quid a year, right? So I mean, that's, you don't need to be incapacitated if you're widowed or a widow, right? The rent credit went up. Anyone with kids in college, as you know, I've slowly but surely started to take back over Cork because I have 3 up there at the moment. But of course, can't afford to live there, so we have to rent. So the rent credit is very welcome. My understanding is the increase up to 1,000 quid is actually going to apply retrospectively for this year. There seems to be ambiguity about that, but there was no ambiguity in his speech, so I think that's going to happen. The mortgage interest credit that was once off last year is actually going to be repeated next year. I'm still using 2022 as base. What this means is if you have a home mortgage, it's only for your home, no investments. If you have a home mortgage and you paid more interest in 23 and 24, you get 2 years of relief. And trust me, if you have a home mortgage, you paid more, right? Because 22 was quite low, 23 and 24 were quite high. So USC changed because of the minimum wage, and they're at being band 2 down from 4% to 3%. It always annoys me when they call that band 2 because it's the third band, but tells you everything you need to know about USC, all right? Just to pause for 1 second, the employer-employee aspect of these things. A few things that people might have not have been aware of. The voucher scheme, as we call it, has always been a problem because the voucher scheme wasn't just a monetary limit, it was also an occurrence limit. I could give my staff a Christmas voucher, £250 once upon a time, didn't 500 quid, right? I could give them a voucher for this every Christmas, but I could only give them one thing. So if I bought them a Mars bar in January, I couldn't give them the voucher tax-free at Christmas, right? It's one event as well as a monetary figure. That became 2 and 1,000. It's become a big problem because the revenue come out going, when Mary got married, you bought her flowers, therefore you blew your chats, right? You gave the staff a pint of Guinness on Paddy's weekend, and you gave them a pancake in February, therefore you have no vouchers available. Now, what the minister has done is basically said, right, you got 1,500, and you can have 5 events, and if you can't manage that, that should cover your fucking pancakes, your Christmas cards, your Easter eggs, your flowers. You can't manage that, don't come back to me. And that's fair comment, right? The other point to note is, because it comes up a lot, I would get asked this on a weekly basis. So I can tell you now for free, or you can email me and get charged later in the year. Where people had the electric cars because of the BIK things, there was never a BIK exemption for putting a charge point in your house. It was ambiguous, but when it comes to these things, ambiguous is not good. When it comes to reliefs, is it clear or it's not clear? And what the minister said is, look, I'm putting that in place next year, right? It's welcome, but by now anyone who has an e-car has a charge at home anyway, but it's still welcome. Companies, no changes to the CT rates, no change to the closed company regimes, which is a problem. The lads will tell you, like, the investments through a company, the taxes, it's not hard, it's Jurassic, right? I think we did a chart one day that if you're not careful, you don't manage yourself, 90% of all your investment income in a company ends up in the revenue's hands as opposed to you and your kids' hands, right? So we would be hoping for changes there, but nothing came. An interesting one for anyone in the business sector with global subsidiaries and so forth is the new participation exemption, which is going to simplify double tax relief. Usually welcome. For Lauren here is going old. trying to deal with all the double tax calculations with India, and God forbid if you have a double whole core structure. So a lot of positive changes there. Nothing on the red tape side of things. We'll have to come back to that. And property taxes, you remember I talked about the vacant home tax a while back. The vacant home tax is a problem for numerous reasons. For those of you who have a big brother concern, every homeowner is obliged to retain a record to prove that it's their home. You know, when someone can knock your door in 5 years' time and say, you owe a vacant home tax, and you say, what are you talking about? I've been living here for 10 years. You can't prove it. You're liable, right? So you now have an imposition to retain all your utility bills, etc., etc. It went from 3 to 5 before it was even introduced, and it's all gone to 7. That's jumping from 3 to 7. It's over doubling of a taxpayer within the first 18 months, right? I haven't seen anything like that since refuge charges. And I still don't know why. We have a whole new regime for what is effectively a couple of thousand houses in the country that gives us a couple of million. So it's going to be interesting to see how that plays out. Unfortunately, the people who get caught with this a lot are people who don't know it. It's to do with inheritances, estates, people inheriting farms, and there's an old cottage on it, etc., etc. Vacant home tax, when you hear it, means I've got a house that I never use. It's not like, it's not a house you didn't even think of using, okay? Also, to remind you, the RZLT is still there. They just kicked it down the road. Very little in this year's budget about it. We'll wait for the Finance Act, but it looks like all they're going to do is make it easier to rezone farmland so you can get the exemption, etc. Just to remind you, if you're sitting there thinking, I don't need to care about RZLT, anyone with a garden of more than an acre needs to be aware of RZLT, because you might need to register. You might need to pay anything, but you might need to register, even if it's your garden, and there's a 3,000 fine if you don't do the right things, okay? CGT, retirement leave, they step back a little bit from the 10 million cap, saying if it's over 10 million, you might still be able to have a relief. What you do is the tax becomes payable, but you delay it, and if you keep it for 12 years, it gets abated in full. Whether there's going to be a tapering or whatever, I don't know. Welcome, but then again, we should never have the 3 million cap, and it kind of, you have to wonder why we got some kind of break on the 10 million with no break on the 3 million, right? It's almost as if people with more money have more influence in these things. Okay, we should look into that at some stage. CAT, the welcome change is we moved the thresholds up at last, right? I think the last change was about 6 years ago. We went from 320 to 335 or something. But that's it. That was the only change, despite rumours to the contrary. I fully expected this to be far more significant. I really did. You had a former minister rambling around the country screaming at everyone that we should abolish inheritance tax. You'd have to wonder what he was doing for 20 years in the government if he was so opposed to it, right? I fully believed that that was to give cover so that when they did do something, they'd be able to look like they were being media. On the left, you should have an inheritance tax of 100%. On the right, you should have no inheritance tax. So if we do something, we look like we're steering a middle road. They did nothing. And that's so disappointing. And then I realized Jesus said, I mean, better if they did nothing. They didn't do nothing. They did something. They have introduced an active farmer test for agricultural leave for the disposal. Now, what you need to be aware of is active farmer test is a mess, and this is going to take a lot of genuine farmers out of the agricultural relief. It's a whole different conversation, but that is the number one takeaway, right? Anyone who thinks that doesn't apply to me because I'm a farmer, you might be a farmer, doesn't mean you're an active farmer, okay? So that's a bomb waiting to go off there. VAT threshold's gone up. Just for anyone listening who happens to be in business or has friends or family in business, I can tell you this is a huge problem with the revenue commissioners. They're tired of people drifting past the threshold and doing nothing about it. They're tired of the fact that they're getting in tax returns with accounts menus saying turnover of 80 grand. There's still no tax VAT registration, okay? Remember, you're obliged to register when you expect to pass it. If you've already passed it, it's too late. If you passed it and done a tax return and done nothing about it, you've taken 2 buses. That's how late you are, okay? Two surprises, not in the changes because they were well flagged, but in the immediacy of the changes. The bulk purchases of apartments and so forth has gone, sorry, not apartments, they're not in the mix, of houses and so forth has gone from 10 to 15 with immediate effect. And a new 4% increase on houses over 1.5 million. Now, also with immediate effect. Just to flag, I've come across this bulk purchases thing about 10 times in the last year, and in all 10 of them, it was an accident. It wasn't some guy went out and bought 10 houses. He bought a house here, he bought a house there, he bought a house there, he bought a house there, he bought this here, he bought a duplex there, and before you know it, he got a harping envelope in the door saying you paid 8, you owe 80. Okay, so just watch out for that, especially this any solicitors listening, because you're the guys who usually get blamed for it, even though you might not know about the previous 9 purchases. Anyone involved in fundraising, I'm lucky enough to have children who are involved in every sport you can imagine. I'm unlucky enough that people see me in a tie, so they assume I want to be a treasurer of every club. I do help with the fundraising. There's a little trick for you. If you help with the fundraising, you never have to put in your own money. I've got time, I don't have money. So this is a welcome thing, although I think they're gonna balls it up. What we were hoping for and campaigning for was something like the old hotels, crashes and all that, where we would sell the allowances, and that would get investors to come in and so forth. What we're going to get is a kind of weak version of charity donation scheme, which has hurt charities, not helped them in terms of their fundraising. So at least it's on the agenda. That's all I say. So look, all in all, what were my takeaways? How do I judge this? Well, again, I don't judge this by what I want. I don't judge this by what I think is right. I judge this by what we were expecting to happen, what we were told would happen, what should be happening, right? We are constantly told how we support Irish businesses. What have we done for them? Nothing. That's bottom line. If you happen to be in the 10 million plus category, all we've done is we haven't hit you as hard as we were trying to. We still haven't done anything on it. Okay. No change to 135A, no change to 817, no change to redemptions, no change to R&D, which has become an absolute quagmire. The relief is simple. The paperwork has become impossible, right? What about the unfairness? Why do professions and self-starters pay more tax? I don't know. Nothing done about it. What about the CAT overhaul? We got the threshold increase, which I'm not knocking. Nothing on the small gift exemption. No update on the mandatory reporting, which we were talking about off camera, whether they're going to have to change that. Now the threshold has gone up, and whether they're going to issue an FAQ and all that. We'll see how that plays out. No change in retirement leave in any meaningful way makes it very difficult for family members. The tax bands has gone up, but well short of the 50,000. That's not my target, that's their target. But if you want to know as to where we should be, if we take where we were in 2010 and move that up with real monies, we're still short of that. So we haven't even caught up to where we were in 2010, let alone the 50,000 target that they have, okay? No change to all the small things, the small gift exemption, the CGT exemption. The CGT exemption is 1,270. For those of you old enough to remember, that comes from being £1,000. That tells you that's 22 years ago. We haven't changed the annual exemption. It's not a tax thing, it's an admin thing. If I make a gain of £2,000, I shouldn't have to do a fucking return and pay an accountant and so forth, but you do. And indexation is just wrong. We are one of the only countries in the world that tax people on gains that they have not made. That is just wrong, right? And that doesn't seem to be on the agenda at all. And entrepreneur relief, which we didn't even bother campaigning for because we assumed it was a done deal, nothing. I mean, again, not my plan. I didn't say I was going to come in and make it 5 million. They did, and they haven't. And if they haven't done it by now, bear in mind this is their last budget, and bear in mind they have more money now than they ever did before, and bear in mind they just found 15 billion behind the couch from Apple, right? So if you're not going to do the one thing you said you would do in your last budget with all this extra money, when are you going to do it? So my point with entrepreneur relief is either fix it or get rid of it. But it's just dangerous there now. It's just dangerous because we're not 100% sure how it works. We're not 100% sure how it'll be interpreted. The revenue have a view, we have a view. We need clarity, we don't have it. Okay. So that was the budget in 20 minutes. What was my takeaway from it? Pre-election. That's my takeaway from it, right? But, you know, we still have to deal with these things. We have to deal with indexation, lads. I can't have people paying tax on money they're not making. It's just wrong. We have to deal with the imbalance. The 3% extra tax that I pay as my own business isn't a huge earner for the state, but it sends out a message. If you work for someone else and get 150,000, if you're a special advisor to the minister on 150,000, you pay less tax than I will if I get out of bed at 6 o'clock every morning and open up my shop and I make 150,000. And the message we're giving is it's easier if you don't have your own business. That's what the price of the 3% is. It isn't the tax it takes in, it's the message it sends. We don't like people who run their own businesses, right? The big failure for me in all of this is we had a chance to do something, a new idea, a new concept, something random. Even if I didn't like it or I didn't agree with it, at least it would be, let's try something. All we're going to do is proceed with where we were already, broadening the tax base, quadrupling the amount of paperwork. As I said, every homeowner in Ireland has an obligation to keep a file. You just don't know it, but someday you'll pay 3,000 fine for not realising it. Everyone who has a garden has to register for another tax. I'm not angry this year. I'm usually angry with these things. I'm not angry this year. I'm disappointed because I forgot to disbelieve them. I went into this with high hopes. I thought John Leaf was a done deal, and I really thought we'd make changes on the obvious stuff, like CAT, like the paperwork for small businesses and so forth. And I came out of this with a bunch of once-off payments for trial benefit and all that, which I'm not going to knock, it's all welcome, but it's not lasting. And with the reminder, of course, everything here is only headlines, and Owen had a note to go with the Finance Act and the Finance Bill. I would say to people, I wouldn't even care about the Finance Bill, because we've learned from experience now the Finance Bill is the show, right? And the Finance Act is the do. That comes in at Christmas Day, so maybe delay everything and then read it the week before Christmas to see what's going to happen. You'll be amazed how often they remember a last minute change to 17 pages of legislation that gets shoved in at Christmas week. So I think that's more or less me. Sean, if you want to go.
Yeah, thanks, Brendan. Very informative, as ever. So we have a number of questions in. One question for you, Brendan, is the employer small gifts. If you have two employments, can you get the exemption from both?
Correct. Assuming they're unconnected now, right? So if I'm working for Sean and I'm working for Owen, happy days. But if I'm working for Sean Limited 1 and Sean Limited 2, different conversation. With unconnected companies, yeah, 2 employers, 2 benefits.
Okay, thank you. Then a question here is, I'll read it. It says, regarding the adjustment for 2 car classes around emissions, is that for VRT on new cars or motor tax or both?
Full of, I have it in the notes that because I didn't fully understand it myself, because cars are getting better and emissions are going down, they're changing the goalpost to be low emissions now. So there's going to be a new emission class, and the answer to that question is it'll affect everything, because your capital allowances, your BIKs, your motor tax, insurance, everything is linked to an emission class, right? So if we're going to have a new class, so what would have been the lower class, what would have been the best class today might be the second best class tomorrow, and that could have implications across the board. What all those would be, I don't know. Whether they'll be grandfathered in, I don't know, right? But the emissions class is built into all of our approach to taxes, from motor tax to BIKs to capital allowances, all that. So I'd imagine if they're going to be changing classifications, it's going to be changing everything. I would hope, touch wood, it'll be from this year onwards and it won't affect ones that you've already got. I would hope. Actually, speaking of that one, do we know if that SFT is going to be grandfathered in? In other words, if I'm over the 2 million cap now, will I be okay? Can time take me out of the
Sure. What appears to be the interesting nuance there is if you had already, let's say, like most people have a number of pensions from different employments, right? So let's say at age 60, they decided to take their tax-free lump sum from pension number 1, right? That they're kind of goosed, right? They're now stuck with the SFT of 2 million. Even if they retire even if they're still working and they won't retire other pensions until 2030, so they're in trouble there. So it'll only, I suppose, as things are presented to us now, if somebody was over that 2 million limit, it's kind of and they haven't crystallized any pensions, it's kind of a sit and wait until the years go by.
It's a game of chicken too, though, isn't it?
How do you mean a game of chicken?
Well, the longer you wait, you're either going to have to put it to sleep You're
Sure.
going to have to hope that you can still stay under the bed when the day comes.
Sure. I know, but it might stop somebody from just maybe making a foolish decision along the way. Like if you had a small pension, not going to say relatively small, well, certainly it's going to be small in the context of 2 million. If you had 100,000 pension from a previous employment, it would be madness to go at that now, because you close off all your options for making that 2.8 million SFT available for you down the road. But look, it's definitely it's going to be, you know what, at least it's something to work with, and it's something that people can use to plan. But that's for now, that's the big caveat, is if you think you're going to need this in a couple of years, don't retire anything, no matter how small it is, from a previous employment now.
And just to flag something that you said earlier that I had my notes as well, that a lot of people didn't pick up on. There is no tax relief on the pension contributions in auto enrollment,
Yes.
right?
Yes.
It's like the old savings schemes where the state is going to subsidise it, and the price of subsidising it is you don't get tax relief. But as Owen points out, tax relief is a lot better than 33%, right?
That's it.
So just to flag that, and I said we'll talk about it afterwards. I have a big problem with auto enrollment because I don't know why they're inventing a third tier. We have the master scheme, we have the PRSA scheme. We don't need this new save as you earn scheme, and therefore we're just going to make an already complicated thing more complicated for everyone, right? But I would echo Owen's thoughts, which is the best way to avoid auto enrollment is to self-enroll. If you're sitting there, you haven't got a pension, and you're in your 30s, I understand it, but you don't have to put in the amount of intention to put in. You could just get the ball rolling. If you're in your 40s, you haven't got a choice at this stage, I think. If you're a marginal rate taxpayer in your 40s, you need to get ahead of the game. I don't care how small you start the ball rolling on it, but get the ball rolling. Because if you get sucked into auto enrollment, you're going to end up doing the same thing anyway, but for a lot less value.
No, this is it. And it kind of has divided, I suppose, employees in terms of their tax relief as well, because just based on one slide when I showed the top-ups, as a percentage, it was fairly clear that a high rate taxpayer should avoid auto enrollment, but it actually improves the situation for a low rate taxpayer who was only getting 20% income tax relief. So auto enrollment, there's an improvement for tax relief on low rate payers, and a disimprovement for high rate taxpayers. So how we're told auto enrollment is going to work, the software is going to be very much aligned with the payroll software. So if your payroll software does not show any pension contribution to, say, a PRSA or an occupational pension scheme, then it'll kick you into auto enrollment. But if a pension deduction is appearing on your payslip for a PRSA or an occupational pension scheme, then auto enrollment just skips you and moves on to the next person. So that's how it's going to work. There was just one question I see came in there as well on auto enrollment. Any clarity yet on the tax treatment of drawdowns from auto enrollment funds? So there is, they are aligning that with the PRSA treatment, which is that there's the tax efficient lump sum will be 25% of the fund, and that's going to be similar for auto enrollment. So if you just think about how do they handle the PRSA on retirement, that's the way they're going to handle the auto enrollment as well.
Okay. Thank you. So we're just hitting midday now, with no further questions. So I want to thank the panelists, and most importantly, I want to thank you, the audience, for logging in today. And we look forward to having another webinar in the new year.